Hi guys, welcome back. I hope you guys had a very good Christmas break and are looking forward into the new year. I know I am, because with the new year comes new investing opportunities. And today we're going to be looking at 6 different companies and what major investment banks and major investment pundits think where these 6 companies could be in the next year. We know throughout 2020 was overall a very, very good year for the stock market. We had a blip towards the earlier part of 2020, but then a lot of companies rebounded pretty well coming into 2021. And that trend continued about halfway, where between September and October, we saw a lot of growth stocks fall off between 40 and 60%. And that was more due to the market coming down to these overvaluations for a lot of these companies, and less to do with these companies actually losing out on their business models or actually having a severe risk that they are undertaking. So today we're going to be looking at 6 different companies where investment banks think they're going to have a big rebound in 2022. We're going to be looking at the bull case, the bear case, some of the risks and some of the benefits. I would like to keep this video pretty short, so we'll be spending just a few minutes on each of the companies, providing a quick overview. I do have some in-depth analysis on some of these, and I'll mention them. If I remember, I'll remember to mention them in the video as well. If not, thanks for watching. On to the video. So the first company we're going to be looking at is Block Inc. It was formerly known as Square, and it's a financial services company. It's based in San Francisco. It was founded in 2009, and it is formerly known as Square Inc. I'm sure most of you guys know about this company. So Square is in the business of consumer payments, and Block is what it's now called, was formerly known as Square. It rebranded to reflect its increasing diversification away from merchant services and into other innovative segments, including blockchain technology. But despite this new direction, Block hasn't abandoned its most profitable segments, which are centered around payment services. For businesses, Block provides hardware that allows merchants to process credit card purchases in store, in addition to loans and other services as well. And on the consumer side, Block's Cash App serves as an alternative to bank accounts for its 40 million monthly users, with its instant peer-to-peer money transfers and even stock and cryptocurrency investing platforms as well. Excluding Bitcoin, Block's various segments have delivered a gross profit margin of 55% so far in 2021, and that's just compared to just 2% for the Bitcoin segment, which mostly derived from Cash App users transacting in the cryptocurrency. Block stock has been crushed recently amid the tech sell-off. There are still plenty for investors to be excited about. The company is now acquiring buy now pay later giant Afterpay, which allows consumers to finance small purchases through Cash App, providing a potentially enormous boost for Block's merchants within the ecosystem. Analysts expect Block to generate $17.6 billion in revenue by the close of 2021, placing the stock's price to sales multiple at about 4.4, which is a significant discount from just 2 months ago, and the company is now consistently profitable. It certainly warrants considerations for long-term investors, especially given how aggressively Block is growing its umbrella of businesses. So just talking a little bit more about Afterpay, which is the buy now pay later company that Block bought. So Block plans to acquire Australian fintech company Afterpay, sent the US digital payments stock up more than 10% on Monday. Square, now formerly Square, now known as Block, is making a big bet on the buy now pay later company, which began its expansion to the US in 2018 and now earns almost half its revenue from the United States. Afterpay is one of the pioneers of the buy now pay later trend, which has exploded in popularity with younger shoppers. Founded in 2015, the company has now more than 16.2 million users globally, and allows consumers to finance small purchases, usually less than $1,000, through participating merchants with no credit checks or interest charges. The model has taken a share from traditional credit cards, prompting many big banks and payment providers to create their own iterations of buy now pay later. Afterpay's business model is very similar to the US-based Affirm Holdings, which is another company we will be looking at later in this video, in that it integrates with the online stores of its participating merchants. Where Affirm charges its customers interest, Afterpay instead charges the merchant a percentage fee on transaction volume, and its net transaction fee is about 2.2%. It provides options for consumers to check out with Afterpay where their purchases are financed. It requires the money to be repaid in 4 interest-free installments over about 6 weeks, and if more time is taken, late fees apply, a key but controversial source of revenue catching Australian regulators last year. The company is by far the global leader among pure play buy now pay later providers, out of which there are now dozens, but competition has led to new twists on the concept. For example, Zip, considered Afterpay's closest Australian competitor. That company introduced a digital credit card, removing the need for integration with merchants and allowing consumers to shop anywhere, and it prompted Afterpay to pivot and offer a similar product to its users. Afterpay has sacrificed profitability as it scales its operation globally, but it has been growing rapidly, with its underlying sales up 102% year over year, its revenue up 88% year over year, and its total users up 63% year over year. The US now accounts for about 50% of total underlying sales, making it Afterpay's single largest market. And you can just look at the graph there. Most of the company's total merchant partners are still in Australia and New Zealand, over 64%, but it added more than 148% more in the US during the fiscal year of 2021. It is likely the company's focus is on users rather than merchants, with consumer-focused products like Afterpay Card. Put simply, Afterpay's future looked destined to be written in America. So, Block's acquisition of the largest buy now pay later provider in the world should see its crush efforts from competitors like PayPal and Citigroup, which has launched its own buy now pay later products. The company has just 2% penetration in the $10 trillion global online payment market, and the company realizes this deal comes with key opportunities for integration into existing platforms. Square's Cash Apps has over 70 million annual active users and about 40 million monthly active users, and is going to introduce Afterpay to them in a move that could trigger the explosion of growth in the buy now pay later platform. It will also use Afterpay to attract new sellers to the Square merchant platform, as financing customer purchases tends to drive sales for businesses. Afterpay is significantly smaller than Square by market cap, but is growing much faster. That could provide a boost to Square's financials in the short term. It'll pay $29 billion, which is 42 times sales in stock in this deal, with each Afterpay shareholder receiving, and we just need to skip this, just the investor takeaway. Square is profitable with a trailing 12-month earnings per share of $1.14, but the stock trades at more than 216 times that metric, which would normally be considered extremely expensive if not for the fact that it is growing so rapidly. That is slowed down to 172 forward PE now. But let's go back to here. In the second quarter, the most recent report results, the company generated $4.68 billion in revenue, over 143% more than the same period last year. And in the full year of 2022, analysts expect Square to deliver over $22 billion in revenue and $2.11 in EPS, which would nearly halve the current sky-high multiple at today's share price. Since the acquisition of Afterpay is an all-stock transaction, the company will not need to take on any additional debt, which means its cash reserves are remained untouched. And while the two companies are expected to greatly complement each other, there is an underlying possibility that the partnership will blow away all expectations. Younger generations are flocking to buy now, pay later in droves, and Square has tens of millions of customers it's ready to introduce to this revolutionary concept. The next company we're going to be looking at is Affirm Holdings, another buy now pay later service, but this time based in the US. And as we talked about previously, while Afterpay charges its merchants some sort of transaction fee, Affirm has a slightly different model, charging interest on the users. So Affirm Holdings, which is down 37% this year and is warranted a big boost coming 2022. So Affirm is the world's largest standalone buy now pay later company, and even despite the recent sell-off it has had, it trailed Afterpay for the past few years. When the company was acquired by Block, it looked as though that Affirm was being left in the dust. However, in a spectacular counterpunch, Affirm has recently secured a deal with Amazon, the world's largest e-commerce company. Affirm will be featured in the checkout of Amazon's online platform. When customers are making a purchase, they'll have the option to finance it rather than paying it with their own money. And when the deal was announced in August, it ignited a rally in Affirm stock from $70 to $176, eclipsing Afterpay's $29 billion deal with Block in the process. Unsurprisingly, Amazon offers Affirm enormous growth in users and gross merchandise value, and combined with Affirm's existing deal with Shopify, it now has a 600 billion per year opportunity in front of it, and that's a 7,000% increase in the GMV it processed in the fiscal year of 2021. And Affirm is now also expanding beyond standard integrations, and is now kind of leaning into physical cards for consumers to use, and they're of course, continually building their buy now, pay later short-term financing as well. The steep correction in Affirm stock presents a strong long-term opportunity for investors, given its innovative approach to consumer finance and the potential offered by its deals with Amazon and Shopify. So the first thing we're going to be looking at is the Amazon deal with Affirm. So a mere month ago, digital payment Square announced the purchase of its buy now, pay later leader Afterpay, but since then Amazon had a deal with Affirm Holdings, offering its customers the option to buy now, pay later at checkout. It is a spectacular counterpunch that could see Affirm take the top spot from Afterpay among global buy now, pay later providers. Here's some background on Affirm and what it might mean for the business. So buy now, pay later is a fresh twist on traditional consumer finance. It's an installment-based lending concept that emerged over the last decade and typically focuses on retail purchases under $1,500. Affirm integrates with the online checkout process of its merchant partners, giving the customer an opportunity to finance their purchase with a single click. The merchant gets the benefit of higher sales because customer has nearer term greater purchasing power, and the merchant isn't exposed to any credit risk because Affirm deals with the customer directly regarding loan repayments. At the moment, Affirm's addressable market is confined to the customers of its merchant partners, but in a move to take more business from the credit card industry, it plans to debut Affirm Card, which is a digital credit card-like product that will incorporate the benefits of buy now, pay later, except customers will be able to use it anywhere rather than only with Affirm's merchant partners. Affirm makes money by charging an annualized interest rate between 0 and 30% depending on the consumer's credit scores, with options for them to repay the money over periods of 3 months to 36 months, which is much different from Afterpay's one of just 6 weeks. But the Affirm card will provide the ability to repay what they owe in 4 installments or on an interest-free basis as well. So what does this Amazon deal mean for Affirm Holdings? While this deal is still in its very early stages, Affirm's merchant integrated business model, Amazon is the crown jewel of retail partners. It's the largest online retailer on the planet, generating $221 billion in sales during the first 6 months of 2021 alone, and is expected to catch 50% of all US commerce sales this year. And as you remember, as we talked about previously in this article, Affirm's primarily used to tie merchants with consumers happens with their merchant partners, and partnering with Amazon, which has access to thousands of merchants all across the world and more specifically in the US as well. You could see that Affirm now has an access to a lot more merchants and therefore a lot more customers as well. Each customer who checks out with Affirm through Amazon would likely need to establish an Affirm account. Right now, Affirm has approximately 5.4 million customers. But through this deal, it gains exposure with Amazon Prime's 200 million members, which is a great boost. Even if, let's say 10% or 5% come through, that's still a big boost to Affirm's customer base. Amazon gets the benefit of boosting some of its customers' spending power. Affirm has an existing partnership with Shopify as well to offer a similar checkout option, and Amazon can draw some key lessons from that deal. Shopify found that using Affirm's buy now, pay later solution resulted in conversion rates of 50% or higher, up to 28% fewer cart abandonments, and checkout times are 27% faster, making it more efficient both for Amazon but for Affirm as well. Buy now, pay later is also popular with younger shoppers. So Amazon might be drawn to the fact that 50% of Affirm's customers are either millennials or Gen Z, and these age cohorts will power e-commerce into the future. So it is important for Amazon to offer the financing options that these customers prefer. But investors will need to wait on further details on this deal. While it appears to be hugely favorable and a win-win at face value, there are some concerns that Affirm's deal with Shopify favors Shopify too heavily, and it could be the disappointment if the Amazon deal is more of the same. And basically what this is talking about is Affirm's deal with Shopify, which once again we will be looking at just after this. is that Shopify tends to get majority of the benefit, with Affirm getting a small benefit. And basically what this is talking about is a similar thing could happen because Amazon is a much larger company, and the way it seems is that Affirm needs Amazon a lot more than Amazon needs Affirm, because Amazon can just partner up with any other buy now pay later service out there. It could be that this deal benefits Amazon more than Affirm, which would reduce the benefit that this article is talking about in terms of revenue and customer increases. So why Affirm might be a buy. For all of Affirm's progress to date, it still hasn't delivered consistent profits. It's not alone. That is a problem that plagues the buy now pay later industry because it has almost no barriers to entry, resulting in seemingly endless competition, which keeps the gross margin quite suppressed. In a previous article, the author suggested that Affirm should explore a full merger with Shopify, as it might be worth as more part of an e-commerce giant rather than a standalone finance provider. But this Amazon deal might be a game changer for the young company. If it results in a complete integration with Affirm's checkout option is offered in conjunction with all of Amazon's sales, there's potential for Affirm to become the single largest buy now pay later player, and with that sort of scale, it might even achieve some pricing power that could leverage and finally reach profitability. And then it just talks about Affirm's upcoming thing. So this is talking about the deal with Shopify and why Affirm is so useful to many e-commerce companies around the world. So stronger together, over 5.4 million consumers are actively using Affirm across 12,000 integrated merchants. When shoppers check out with Affirm, their purchase is financed at an annual percentage rate of between 0 and 30%, depending on the credit, across 3, 6, or 12 months as well. Affirm's customer base is a drop in the bucket when you consider that Shopify powers an estimated 1.75 million online stores, which are the primary focus of the partnership between the two companies. But focusing on the merchant side might be a little bit too one-dimensional. Affirm recently announced that it will be launching the Affirm Card, which is a consumer-focused product that will allow shoppers to take advantage of the buy now pay later service wherever they wish, rather than with only Affirm merchant partners. It separates the Affirm experience from the shackles of its merchant system and sets consumers to take free advantage of the same benefits at stores more suited to their needs. Shopify has currently 118 million registered users across its Shop Virtual Assistant platform and Shop Pay payment products, which is substantial proof of customers might be enticed by the offer of the new age replacement for their credit card. Square is already planning key Afterpay integration with both its seller platform and its 70 million Cash App using customers. And this is a move that Shopify could learn from. The buy now pay later drives sales. It comes as no surprise that financing consumer purchases with no fees and little interest encourages people to spend, but it might surprise you by how much. Shopify is in the process of pitching its buy now pay later solution, which is powered by Affirm, to its merchants, and it has provided a series of selling points. The company claims that it will increase conversion rate by 50%, reduce cart abandonment by 28%, and enable larger cart sizes because consumers have the flexibility to buy more. Half of Affirm's customers are either millennials or Gen Z, and the company notes that 79% of this cohort shop using a smartphone. Buy now, pay later products is driving up engagement, with a 64% of transaction in the fiscal year of 2020 made by repeat customers who spend close to $2,200 annually just on average. So this is basically talking about how beneficial it is, Affirm, to its users. The next company we're going to be looking at is Upstart, which is an AI-based lending platform that partners with banks and credit unions to provide consumer loans using non-traditional variables such as education and employment, rather than just looking at the basic, I think it's between 10 and 20 different factors that are used to determine credit scores and manage interest rates. And using AI, this basically makes it a lot more efficient for Upstart and the people that they partner up with. So Upstart Holdings is down 60%. And the third and final stock that's down big and worth buying right now is Upstart Holdings. It's one of the best performers of 2021 with a 280% year-to-date return, even accounting for the recent 60% collapse in its stock. At one point in October, Upstart had gained over 800% for the year, with a price of $401 before trading to $155 where it trades at today, currently trading at $148.97. The company has leveraged AI to transform the way that banks assess potential loaners. Upstart goal is to use its technology to unseat the decades-old FICO credit scoring system by analyzing over 1,000 different data points to gain a more comprehensive perspective of potential borrowers. So by analyzing over 1,000 data points, they are resulting in 75% fewer defaults for the same approval rate, which is a very good sign. The company began its unsecuring lending before entering its largest market yet, secured vehicle loans. It has built an impressive network of car dealerships, and it's done so quickly through its acquisition of Prodigy, which is a car sales software platform, also now known as Upstart Auto Retail. In its third quarter, it had 291 dealers using the new sales and loan origination service, up 219% from the same period last year. Since Upstart is a loan originator, it doesn't lend any money itself and therefore carries almost no credit risk. It earns a fee when its banking partners write a loan using its algorithm, and it also sells its software to institutions that want to integrate it into its application process. At the beginning of 2021, Upstart estimated that it would generate $500 million in revenue for the year, but now it's in track to deliver by close to $800 million. And in 2022, analysts estimate that it'll bring over $1 billion for the first time in the company's history. But with that rapid expansion of its vehicle lending segment, it could blow all projections out of the water again next year, which currently makes its discounted stock price a major opportunity. The next company is Teledoc Health. I'm sure you guys have heard a lot about this company. And the company has had a massive correction recently, coming down from $300 all the way to $91. So Teledoc reimagines healthcare. It's a virtual first platform that allows patients to meet remotely with clinicians, making the experience less costly and more convenient. Differentiate itself, Teledoc has invested aggressively in expanding the scope of its services, and the portfolio now spans 450 subspecialties from general health to wellness to acute and chronic care as well. Of particular note, Teledoc last year completed its acquisition of Livongo, which is a healthcare platform that leans on AI to improve outcomes in chronic conditions like diabetes, hypertension, and weight management as well. The move has not only extended Teledoc's portfolio, but has created a source of potential synergy as acute care physicians can now refer patients directly to chronic care programs. As a whole, Teledoc is the most comprehensive telemedicine solution on the market, and from a financial perspective, that edge has translated into strong revenue growth, with its quarter 3 of 2020 being $867.1 million, $1.9 billion in quarter 3 of 2021, which is a 115% increase in revenue. Unfortunately, Teledoc's membership growth has slowed substantially in the wake of the pandemic. During the most recent quarter, paid memberships rose just 2% to 52.5 million, and investors need to monitor this metric closely. Some deceleration is natural, but if Teledoc fails to re-accelerate membership growth, the company could be in trouble. That being said, the management is making quite a lot of smart moves. In October, Teledoc launched Primary 360, which is a virtual-first primary care solution that pairs patients with a dedicated physician. That service reinforces synergies created by Teledoc's broad portfolio, adding another touch point at which physicians can refer patients to chronic care programs or specialists like mental health professionals. On that note, Teledoc also launched My Strength Complete in the second quarter, which is a mental health service that includes clinicians and in-app tools that helps patients manage stress, depression, and other mental health conditions. Also noteworthy, Teledoc has seen promising growth in its chronic care programs, as the number of enrollees jumped 31% to 725,000 in the most recent quarter, and the number of patients enrolled in more than one chronic care program tripled. All things considered, it's not hard to imagine Teledoc's share price rising more than 130% over the next 12 months, especially if the company can onboard new members quickly. The next company we're going to quickly be looking at is Root Insurance, which is a car insurance company that has seen quite a lot of growth in the near term and then seen the stock crash as well, more than 90%. So about Root. So Root has an implied upside of more than 240%. Small cap stocks are expected to get in on the action too, following an abysmal year that's seen shares of the insurance company decline by close to 90%. At least one investment bank is expecting a big rebound. Based on Wall Street's high price of $11, Root offers an upside of 240% in 2022. For decades, the auto insurance industry has used an assortment of metrics such as credit score, age, and marital status to determine how much their members should pay each month. Unfortunately, these figures don't actually tell insurance companies how well or poor, how good or how poor a driver of someone is. Root is aiming to disrupt this industry by relying on telematics. In simple terms, Root is using highly sensitive equipment found in smartphones to detect G-forces while driver brakes, accelerate, and turns, utilizing true driving data as well as driving trends within a state or region. This could allow the company to accurately price policies upfront for new members. On the downside, Root is a relatively new player, which means it's going to have to spend aggressively to build up its brand, which means sizable losses are expected to continue. However, the initial accident loss ratio has been mostly encouraging, with gross accident periods loss ratios coming in at below 100% for much of the past 2 years. A figure below 100% implies a profitably written policy. The data suggests that a telematics-based approach can be very, very successful. While it is an extremely risky investment, it does offer an incredible reward potential as well. And the last company, I'm sorry this video took so long, is C Limited, and I've done a video about this as well, and the stock has corrected quite a lot, coming down from $357 down 40% to $216. So C Limited has an implied upside of 107%. Wall Street also sees big things happening for the Singapore-based company C Limited, which has seen its precipitous downtrend over the last 2 months. If the $460 price target from Goldman Sachs analyst Piyush Miyabi is correct, megacap stock C could more than double in value over the next year. The lure of C Limited is that it has the trio of rapidly growing and diversified operating segments. For the moment, the company's digital entertainment division is the only one of its 3 generating positive earnings before EBITDA. C mobile game Free Fire continues to be a worldwide hit. In the September-ended quarter, 12.8% of its 729 million gamers were paying to play, and that's a pay-to-play conversion ratio that's many times higher than the industry average. Secondly, C's nascent digital financial services is gaining traction. Things are now coming. More than 39 million people are using the company's digital wallet services, with its payment volume hitting 4.6 billion in the third quarter. And the third, the fastest growing segment, is arguably what investors are so excited about C, is its e-commerce platform Shopee. Shopee is consistently the most downloaded shopping app in Southeastern Asia, and it's gaining plenty of appeal in Brazil as well, since it's primarily targeted emerging market countries with burgeoning middle classes growth of its scale. The $16.8 billion in gross merchandise value on Shopee in quarter 3 is more than the 10 billion GMV for all of 2018, which gives you an idea of how quickly this segment is growing. While $460 in 2022 might be asking a bit much, the upside does seem quite warranted. So that brings me to the end of this video. We did see a wide range of companies, and I hope you enjoyed. If you find it useful, let me know. If you didn't find it useful, you can let me know what I think I could do better next time. And if you did make it to the end of this video, share it to a friend. Let me know what you think about these companies, and also consider subscribing. It does help me out a ton. If not, thanks for watching anyway, and I'll see you in the next one. Bye.